In this class, we'll continue with what we did in class 4, but I think today what we did in class 4 tends to be one of the more confusing classes because I'm introducing material, but we haven't applied it. So some students, it's like, okay, I don't know where he's going with this. Today, we'll actually do the entire application. We'll do the measurement and the mitigation. Today, before we do the mitigation, I want to introduce you to interest rate swaps in case you've never seen them before, have a little bit of background on them. But I think they'll make the most sense when we actually do balance sheet immunization. So we'll do an entire problem where we'll do the measurement and the mitigation using swaps, and then we'll specifically get into dollar duration gap analysis. So a swap is a derivative, which means it's not actually an investment in a normal sense because it gets all of its value off of something else. It's tied to something else. That's why they're called derivatives. A derivative derives its value from something else. In this case, we are going to derive our value from some index of interest rates because we're using interest rate swaps. Not all swaps are interest rate swaps. So you can have stock index swaps, currency swaps, which might be interest rate swaps, and currency swaps are probably the two largest. Commodities swaps, even weather swaps. um, so, we're looking at a fairly probably the largest derivative out there. The notional amount of this is just massive. We'll have to talk a little bit about notional amount, but just massive, massive valuations. Um, and so to understand a swap, I really think you have to do an example. So we'll do it an example. Uh, the complexity of an interest rate swap, I think, is in getting them initially set up. I remember at UTSA, I wanted to do interest rate swaps, so I started the process of first getting it approved, which took months, but then actually getting the contracts done, and it took me months to get the contract done. Let me show you some language from an interest rate swap just so you can see that they're a little bit complex, but there's something called an ISDA, which is a standardized contract that was developed many, many years ago. What I'm going to show you is the contract I had to work with. I don't know if they've revised it since then. There's a link in the file, but the ISDA is the International Standards. I forget exactly, swap something, but it's a group that specifically is in charge of swaps, not just interest rate swaps, but all swaps. So there is International Swaps and Derivatives Association. I always forget their title, but here's a link. I'm not sure if that link still works, but a link. And here's the actual draft contract that they came up with. You can see there's some typos in there just because I copied and pasted it in, and there's a lot of places it just did not copy in very well. So I didn't clean this up entirely. I just want to give you some sense of how these contracts works, and that looks like a long German word. So my challenge was I was being, I learned about swaps when I took the CFA exam. The CFA exam had an entire book, which its only purpose was to equate swaps and futures. That was the purpose of the entire book, was interest rate swaps, interest rate futures, trying to show that mathematically, or actually proving mathematically they were the same. I've loved that book. I really got into it quite deeply. I could not do that today because it's been years since I did that, but I sat down, did all the math, really, really enjoyed it. They had a major swap question on the exam. Unfortunately, it was a currency swap, and I hate currencies, so it was a tough exam question for me. I wish they'd asked an interest rate swap question. But here's the contract. So I understood swaps very, very well after the C of A exam. I understood how they were. I'd seen them, some practice. I talked a lot to some investment banks about it. But then I had to get the contract approved. And so this is the contract we were given. And I read it and read it and read it over and over and over again. Let me show you a little bit of the language. One is on the netting. Now the netting is really, really important, and that's something you're going to have to talk about in your paper 1. These master netting agreements are really important. And what they mean is, with the way a swap works, sometimes I owe you money, sometimes you owe me money. Depends on how the interest rates are moving. But we want to net that. I don't want to pay you $1,000 and you pay me $600. If I owe you $1,000, you owe me $600. We just want to net that, and I send you $400. So this is the language they had in the contract. It says, if the aggregate amount that would otherwise have been payable by one party exceeds the aggregate amount that would otherwise have been payable by the other party, replaced by an obligation upon the party by whom the larger aggregate amount would have been payable to pay to the other party the excess of the larger aggregate amount over the smaller aggregate amount. Now I know what that is saying, but my word, that is really wordy, complicated way to say something really, really simple. So I kind of understood that one, but then I got to other phrases like this one. This one is on the right of termination, and the right of termination to me is extremely important. We're going to talk about counterparty risk, and this is really, really important. What happens if the other side of this transaction goes insolvent and they owe you money? So, and what if you want to terminate this contract? This was extremely important to me, that I be able to terminate this contract at any time, get my money back the same day. So I wanted to get out at market value. So if the market value was positive $100 million, I wanted to get out. I wanted them to send me $100 million on that day that I wanted out of the contract. And so here I come to this section, and just look at the wording here. If, however, automatic early termination is specified in the schedule as applying to a party, then an early termination date in respect of all outstanding transactions will occur immediately upon the occurrence with respect to such party of an event of default specified in these sections, or to the extent analogous thereto. I hate that legal kind of language. And as of the time immediately preceding the institution of the relevant proceeding or the presentation of the relevant petition upon the occurrence with respect to such party, an event is default specified in this section, or to the extent analogous thereto. So first of all, I got to go look at all of these sections, which are all worded like this, and I got to figure out that. So to me, I read it and read it and read it, went back and forth, right back and forth, and I still wasn't absolutely sure exactly what the contract was saying. My lawyer at USAA had never dealt with swap contracts before, but he said, we have a firm that they're specialists in this. We're going to hire them. So they came in, 2 lawyers came in. I was with 2 lawyers plus my lawyer, and I took them specifically to these types of sections that I said, what is this saying? They looked at it and they said, we don't know what that's saying. And I'm just like, okay, so you're the experts in this area and you can't tell me what this passage is saying. So I finally had to, on a swap contract, and you might try this as well if you swaps, I finally said, okay, I need you to tell me, these are the things that are most important to me. I need to tell you that this contract says I can do these things. And I listed out the several things that were important to me. The most important one was, if on Friday at 8 a.m. I want to get out of this contract, and I want to get out of it today. If my market value is $200 million, I want the other side of this contract, to be required to send me $200 million that day. And they will have it, because if the market value is $200 million, they will have over $200 million set aside in an account backing up this contract. So they'll have it. I want them to be able to send that to me the same day. And the lawyers assured me that yes, that will happen. But these are conflict, so make sure to give yourself time to review these contracts. So that is a key risk of this contract, is the infrastructure. So I've heard a lot of people say, you know, we're not ready to do swaps right now, but we might do them in a month or 2 from now. We'll see what interest rates are going to do. I strongly recommend that if you are interested, if you're at your firm and you're interested in any kind of derivative, whether it's options, futures, swaps are a type of future, whatever you're doing, I strongly recommend that you set up all of the infrastructure well before you need to do the contract. So for me, I wanted to do swaps, so I started working on the contract at the same time I was getting it approved by the committee. And it took me several months to get the contract approved. It also took me several months to get the committee approval. And the reason it's so complicated is there's several parties. I was doing this for a pension plan, so you have to think about the complexity. We're going to talk about disclosure risk and legal risk later in this class. This is a big deal for finance, so you need to start thinking about this now, or you're going to have a day in your career you're really going to regret that you had not thought ahead on these type of things. I sure did in my career. These are complicated. So when I was doing a swap contract for a pension plan, I had to sign the contract for USA. USA had to sign the contract. My custodial bank for the pension plan, they had to sign the contract. The investment bank I was doing the contract with, they had to sign the contract, and their custodial bank had to sign the contract. So 4 parties had to sign this contract. You saw how complex that contract was. My lawyers would look at it. They would have language changes. My custodial bank, the investment bank, their custodial bank, all lawyers are looking at that. One lawyer at one bank will change 2 words, and now it's got to go back to all the other lawyers. You send it back to all the other lawyers. One lawyer is on vacation for 2 weeks or has a stack of other stuff she's working on. My lawyers, he's working on stuff. I remember walking to my lawyer's office. He always had a stack of paper up 5 feet high everywhere, just all over the place. Overworked, no time, and I was constantly pushing. Please, I got to get this done. I even one time called an investment bank and told them, you know, if we can't get this done, my CEO will be calling your CEO. I don't know if I could have gotten that to have happened, but I was using maximum pressure I could get that we've got to get this done. And finally got the contract done. I remember one investment bank said, oh, we're fast. We'll get that contract done for you in a month. I remember 9 months later, my lawyer called me and says, we can't deal with this investment bank. Their lawyers are just too difficult, and we never got a contract done with them. So get this infrastructure set up, even if you never use it. So you're kind of wasting money and time because you're using all this lawyer time. But we'll talk about, you know, the importance of options. The ability to do something, even if you never do it, is a very powerful thing for risk management. Get these things set up, get them approved, get them implemented, even get them tested. Even though you maybe only do $10,000 just to get them tested, it may be hard to do a swap that small. But do something so you make sure you can proceed when you need to. Then when someone calls and says, let's do this, once the contracts are set up, you have to do the contract and the annex. There's a lot of extra paperwork, but once it's all set up, execution is very fast. The first swap contract I did, so we had everything set up. I was finally ready. I got interest rates right where I want them. I remember the 5-year Treasury got up to 5.25. You can believe that. The 5-year Treasury is like not even 0.5% now, so it's 10 times higher than what it was now. I wanted a swap to protect me. I needed protection in case interest rates fell, and we're going to talk about that when we talk about pension plans. I thought a 5.25 5-year Treasury was a really good rate to execute at. That rates were pretty high, and they're more likely to go down and up, so I was ready to execute. It was one phone call, and I was able to execute billions of dollars in notional amount, in dollar duration amount, in one phone call. In fact, the phone call took longer than it needed to because my swap dealer said, I think I can get you a slightly better deal. So while I was on the phone with him, he was waiting, looking for a better deal, pick me up a basis point or two. So be aware of that. That's one of my strongest recommendations to you as a finance major or an actuarial science major. Actuaries use derivatives a lot in their field as well. Get the infrastructure set up. Do not listen to these banks. They will all tell you, we can do it fast. We're really good at this. That is an absolute lie. They cannot get it done fast. These things always take longer than you expect. So yeah, make sure you have it set up before you need it, and then when you need it, you can move fast. And as I said, there's several parties to this, and they all have to approve it. All right. So here's a few charts. I wish I could show you that. There's a website a student showed me. It was really cool. I just don't have it easy access to it. But this just shows you the notional amount. We'll have to talk about notional amount. These are over-the-counter derivatives. So you can look at the total, the left hand, and look at these numbers. This is a kind of a shocking number. This is the total right here. Look at this line. That 650 is not $650 billion. That's $650 trillion. These numbers are absolutely massive. Here's the market values. The market values are massive as well, but the notional amounts are massive. Now the market values and the notionals are a little deceiving because you have offsetting sides. So someone might have $3 billion, the other side has negative $3 billion. They offset each other. That becomes $6 billion of market value, but so there's a little bit of double counting, but still these are massive numbers. $650 trillion is several times, many times the value of all the economies in the world. You know, the U.S. economy is what, a $20 trillion economy. I don't know what it is on a nominal basis, but massive numbers. So this is, you know, 20, 30 times the value of the U.S. economy or the world economy, 10, 15, 20 times. So these are massive numbers. So we have to understand this concept of a notional amount, because the numbers are scary. You think, my word, these things could wipe out the entire world. They're so massive. But the key is understanding what notional amount is. So we'll get into that today because I do want you to understand that. All right, so before we get back into that, we are going to do an entire example here. So this is one I think this will all make sense. We're going to do a full balance sheet immunization problem. There's a few formulas you need. They're easy formulas. First, the duration of net worth. Here's the formula. It's the duration of assets minus the dollar amount of liabilities divided by the dollar amount of assets times the duration of liabilities times leverage. Leverage is dollar amount of assets over dollar amount of net worth. So there's the key formula. I would know this formula. I learned this formula on the CFA exam, came back to my company, and I showed it. I went to one of our bank's asset liability management committees, and I was telling them about this from the exam, and none of them have ever heard of this. So I was actually teaching them how to do bank balance sheet immunization, even though their responsibility was bank balance sheet immunization. So it's powerful stuff to know stuff that other people aren't learning, and boy, it gives your career a big boost. All right, so let's do a problem. The best way to learn this is to do a problem. So remember, we're going to start with measurement. This is our measurement, so keep that clear in your mind. Make sure you're always stepping back to the foundation, fundamentals of what we're doing here, so you don't get confused. So our measure of interest rate risk is going to be duration of net worth. Think of this in terms of a bank. Our mitigation is going to be balance sheet immunization using interest rate swaps. All right, so let me say that one more time. Write it in your notes. Put it on a piece of paper next to what we're doing. So our measurement of interest rate risk will be the bank's duration of net worth. Our mitigation of interest rate risk will be balance sheet immunization using interest rate swaps. All right, sounds complex, sounds pretty involved. Imagine if you really understand this, and I think you will. Students don't have much trouble with this once they go through a few examples. Think about this coming up in an interview question, and just, boy, you're going to sound much smarter than 99% of undergraduate students. So let's understand this. Let's make sure we get into this. So here's a bank. It's an unusual bank here. They have some cash. They have $150 million in cash. Cash, by definition, has a duration of 0. That's not much interest rate risk at all. Interest rates can go up or down, and cash just stays right at 150. They have some loans, $850 million in loans. Now they have some very unusual loans. The duration of the loans is 5.2 years. Now you might say, well, that's not all that long because auto loans are what, 4 or 5, 6 years. But remember, or maybe you've never learned this, so this is probably pretty important information. If you learn duration, like in my investment class, we talk about duration. So a 10-year treasury has a duration of maybe 8 or 9 years. So duration for a lot of bonds, duration is kind of close to maturity. A 10-year bond has a maturity of about 10 years, but a duration maybe of 8 or 9 years. When interest rates are low, duration is much closer to maturity. A 30-year bond might have a duration, say, of 20, 21 years when interest rates are really low. But you have to remember, a treasury bond pays only interest every 6 months. And then at the very end, it pays principal. Remember, duration is the weighted average time to maturity, using those times as the, those discounted cash flows times as the weight. Well, if the only cash flow you're getting is coupon, you're getting coupon every 6 months, so you're getting paid interest every 6 months, and at the very, very end, you get all your principal back, then the weight of the cash flows will be very, very skewed to that very last cash flow where you get principal interest back. But that's not how banks do loans. Bank loans are what we call amortizing loans. So you think about your auto loan. As you're paying off your auto loan, you're paying interest and principal as you go. So there's a lot more cash flows up front. So a 5-year auto loan might have a duration of just 2.2 years. It's going to be skewed more. So 5-year duration for a bank, that is massive. Even a 30-year mortgage might have a duration only about 8 or 9 years. It's very similar to a 10-year treasury. So a 5-year duration for a bank, that's a long duration. So that's why I say this is a very unusual bank. They have very long duration loans. Credit card loans have duration of essentially 0 because you can change your interest rate on a credit card loan every single month. So duration is very, very short on that. An auto loan, if you have 4 and 5-year auto loans, their duration is only 2 to 3 years. Mortgages, maybe 10 years, but banks don't usually have that many mortgages. They usually securitize them off. So anyway, so this might be a lot of terminology. You'll just have to trust me that 5.2 is a pretty long duration for a bank's loans. So their total assets is $1 billion. They have $750 million in debt. The duration of that is 3.75. This is probably the easiest number to calculate on the balance sheet. It's very easy to calculate the duration of debt. So what we want to know is their net worth is 250. What is the duration of net worth? And again, we'll use this formula to do it. So let's plug the numbers in. So the duration of assets. So remember, they have 150 million in cash, which is a duration of 0. So 15%, 150 over $1 billion, 15% has a duration of 0. 85% has a duration of 5.2. The duration of assets is just that weighted average duration. So it gives you a duration of assets of 4.42 years. All right, the duration of their net worth, we plug that in. So remember, duration of assets. Let me bring this formula down so you can see it next to the formula I'm doing here. So we take duration of assets. We just calculated that at 4.42. We take the dollar of liabilities. Remember, that was 750. The dollar of assets, remember, that's 1 billion. Times the duration of liabilities, I just gave that to you, is 3.75. You take all of that and you multiply that by leverage. Leverage is just, sorry, come on, Bill Gates, leave me alone here. So you take total assets divided by net worth. $1 billion divided by 250. We get a duration of net worth of 6.43 years. So what would happen to the net worth of this firm if interest rates were to fall 150 basis points? 150 basis points, you adjust that to a percent or to a decimal by dividing by 10,000. You always divide by 10,000. So 150 basis points is 0.015 or 1.5%. If you're not familiar with basis points, learn it now. It doesn't matter if you're a finance major or an actual science major, you should get so you can speak basis points in nanoseconds. 10 basis points is 0.0001. It's 0.1%. 50 basis points is 0.005 or 0.5%. All right, make sure you get really fast for that. So here we said if they fall. So this is another formula you need to know. It says that the percentage change in net worth will be minus duration times the change in yields. So here we have minus duration. Duration is positive 6.43 times minus 0.015. Interest rates fall 150 basis points. So if interest rates were to fall 150 basis points, we would expect net worth to rise 9.645%. Or since net worth is $250 million, we would expect net worth to go from $250 million to $274 million. Now let's check that and let's see. All right, duration of assets is 4.42. So how will assets change? Well, assets will change minus 4.42 times minus 150 basis points. If you do that and calculate it out, you expect assets to rise 6.6%, or rise from $1 billion to 1,066. Liabilities, their duration is 3.75, so minus 3.75 times minus 150. Liabilities should rise from 750 to 792. You take 1066 minus 792, and you see net worth should rise to 274. Now here, your liabilities did rise. They rose $42 million. But your assets rose $66 million. And because of that, your net worth will rise $24 million. You don't have to do this on the exam. I'm just showing you. It's really straightforward math. All this formula up here is doing is taking all of this and putting it into one formula so you can quickly calculate the duration of net worth. All right. I think I might leave this in the notes permanently so you can see the formula right next to the actual equation. So it's really nothing more than plugging numbers into the formula. It's very simple. The actuaries in the room, they'll look at this math and they'll say, hey, there's a way to simplify this math, and that's true. You can simplify this formula. I recommend that you don't. I like to do formulas so that even though it's a few more steps, even though I could simplify this, it's a few more steps, I like to do it so that my mind is thinking about what I'm doing. So it's essentially duration of assets minus duration of liabilities times leverage. However, because my liabilities are not as big as my assets, I've got to do this little bit of adjustment. So you notice here, if liabilities had a duration of 4.42, if my assets and liabilities had the exact same duration, my duration of net worth would not be 0. And why is that? Well, because my liabilities are not as big as my assets. My liabilities would have to have a higher duration than my assets to get my duration of net worth exactly to 0. All right. Now, does this meet board policy? Well, here's their board policy. They say if interest rates, now some students get really confused on the exam. This question 3 has absolutely nothing to do with question 4. All right, sometimes I've even stopped asking question 3, but I think I'm going to keep asking it because I don't know why students get so confused. This is simply a stress test question. What would happen if interest rates fall 150 basis points? The 150 basis points is not even in this table for the board. All right, so this is just another scenario. Okay, here's the 6 scenarios the board say you need to run. I just ran a 7th one here. It's completely unrelated, all right? So I actually like asking that question because students that get confused are obviously missing something in the understanding here in the critical thinking. So question 4 is completely unrelated. The board says Here's the 6 scenarios I want you to run. So remember on paper 1, we talked about the term stress testing. So this is the stress testing that your board requires you to run. All right, so if interest rates were to fall 100 basis points, your net worth should not fall more than 5%. All right, now we know if interest rates were to fall 100 basis points, so minus 6.43 times minus 0.01, that our net worth would actually go up 6.43%. We would be in compliance. This bank is in compliance anytime interest rates fall. Why? Because the duration of net worth is positive. So this bank actually benefits when rates fall and loses when rates rise. So you can see here, anytime rates fall, the bank as well is in compliance because negative 5% is the standard, but they're up 6.4%, 4.3%. So they're in compliance. When are they in trouble? They're in trouble when interest rates rise. Here they say if interest rates rise 100 basis points, so you take minus 6.43 times positive 0.01, you'll see that they lose 6.43%. That's worse than the board allows. So in these 3 scenarios, they are out of compliance with the board's policy. They fail. So the bank violates the board policy when interest rates rise because the duration of net worth is 6.43. You should be able to tell from this board's policy what the allowed range for duration of net worth is. And the allowed range is anywhere from negative 5 years to positive 5 years. Because negative 5 years, you would do minus 5 times minus 0.01, you get negative 5%. So with negative 5-year duration, you would be in compliance. With positive 5-year duration, you have minus 5 times 0.01, you would lose 5%. You'd be in compliance. This bank's duration of net worth is not 5 years. It's 6.43 years. And because it's 6.43 years, it's over the bank's policy limit, so they're out of compliance. The duration of net worth is too high. They need to reduce the duration of net worth by either reducing the duration of assets or increasing the duration of liabilities. All right? So when duration of net worth is too high, you need to reduce the duration of assets or increase the duration of liabilities. The exact opposite is true if its duration of net worth is too low. If the duration of net worth was negative 7 years, then you'd want to increase the duration of assets or reduce the duration of liabilities. All right, so we're going to practice here where the duration of the net worth is too high. So what could you do? You could stop doing 5-year loans and instead do more credit card loans, but we don't like that because the sales floor doesn't want to have to sell 5-year car loans if no one wants 5-year car loans. I'm sorry, no one wants to do credit card loans if everybody's doing car loans. So you don't want to have your sales force have to stop selling something because the finance messed up. That disrupts operations. How do you increase the duration of liabilities? Well, you push for longer-term liabilities. So you try to sell more longer-term certificates of deposit and try to get rid of savings accounts and checking accounts. Well, that's, again, going to disrupt bank operations. You could switch from short-term debt to longer-term debt. But that's probably not a good idea because most banks are in the shorter-term market. The debt markets, the longer-term debt markets are not that familiar with banks, and so they're going to have to pay a higher rate because of lack of familiarity out there. You don't want it to go into debt markets you don't normally borrow in. So what's the answer? The answer is to use derivatives, either futures, forwards, or interest rate swaps. We are going to use interest rate swaps. And what will we do? Well, we're going to view this. It's really important. Get this into your notes. Swaps, you can view swaps either on the asset side or on the liability side. For banks, we're going to view the swap as being on the liability side. With pension plans, we're going to view them being on the asset side. So I want you to view this that this swap is on the liability side. Remember, we want to increase the duration of liabilities. So we are going to swap from floating to fix on the liability on the swap. A floating liability has very short duration and very low interest rate risk. A fixed swap has longer duration, more interest rate risk, more duration. So we want to swap from a floating rate swap into a fixed rate swap. So let's do that. We'll practice with that. That doesn't make sense. You'll see it as we do this problem. All right, so we're going to get into swap. Let's first, before we do that, let's look at what this entity is doing without the swap. So there's two entities. There's AAA and there's BBB. We don't know which side, which entity this is, but we're going to get into this as we talk about how to mitigate the risk. But this entity, AAA, this doesn't have anything to do with swap yet. We're just saying, okay, AAA, they're the higher rated company. If they went out and borrowed fixed rate, they could borrow at Treasuries plus 125. So 5 years. If they did this, they would lock in this rate. So Treasury rates were 3%. 3% plus 125 is 4.25%. They could lock in 4.25% for 5 years. They would pay exactly 4.25% for 5 years. BBB, because they're not as high credit quality, they could lock in that 5 year at Treasuries plus 1.85%. So at Treasuries are 3%, they could lock in a 4.85% rate. Fixed for 5 years. It would never change. If AAA borrow floating, they could borrow at LIBOR plus 10. Now I'm still using LIBOR. LIBOR is the London Interbank Offer Rate. It is the standard for floating rate debt until who knows when. LIBOR is going to be replaced by something else. It is going to be a massive undertaking. I don't know where they are on that project. I saw one of my former students actually did a paper on that. Very interesting paper on how they are going to replace LIBOR. I just showed you there's $600 and something trillion in swap contracts out there. Every single one of those swap contracts is priced off of LIBOR, and they now have to replace it with something else. And they can't just pick something else that's, say, 20 basis points higher, because that's trillions of dollars in cost. People are going to be really upset. So it's going to be really interesting to see what they finally come up with. I think they're leaning toward a particular one right now. I don't know if they've officially switched to it, but anyway, so LIBOR plus 10 basis points. What that means is if LIBOR is 2%, they're going to pay 2.1% this quarter, but next quarter, if LIBOR goes up to 2.5%, that quarter they're going to pay 2.6. So this rate will keep switching every 3 months as LIBOR changes. So it's a floating rate. They don't have it fixed for 5 years. For the next 5 years, every time LIBOR changes, what they pay in interest is going to change. BBB can borrow at LIBOR plus 20. All right. Now this is pretty common for longer term debt. Lower rated companies have a much higher spread. This is what this is called, the spread, how much they pay over Treasuries. It's a much higher spread versus AAA than they would on LIBOR. So here we'll look at the difference. The key here, this is the first thing you want to do on this problem, is write the difference. What's the difference here? The difference here is 60. BBB pays 60 more than AAA, 185 minus 125. So AAA is 60 basis points cheaper than BBB. Here, it's only 10. Now you notice AAA is cheaper on both, obviously because they're the higher rated firm. So obviously their debt is going to be cheaper in both cases. But the first thing you got to figure out is who has the comparative advantage in fixed rate debt. AAA, wherever AAA is cheaper, that is where AAA has the comparative advantage. Wherever AAA is not cheaper, it's more cheap. I got to see this exactly right. 60 is greater than 10. Wherever this number is bigger, that's where AAA has the advantage. Wherever this number is smaller, that's where BBB has the advantage. Comparative advantage, all right? Be really, really clear on this. AAA has the absolute advantage in both. They're cheaper on both. but AAA has the comparative advantage in fixed rate, and BBB has the comparative advantage in floating rate. Some students really struggle with that. How can BBB have an advantage if they're 10 basis points more expensive in their cost of debt? We're talking about a comparative advantage. This is very similar to the comparative advantage you had in economics. One country might be able to produce two things cheaper than another country, but comparative advantage is they should produce the thing that they have the bigger advantage in, and the other country should produce the thing they have less of a disadvantage in, because that's where they have their comparative advantage. If none of that makes any sense to you, then just know AAA needs to be in the swap where they have the bigger advantage. BBB needs to be in the swap where they have less of a disadvantage. All right, so AAA has the comparative advantage in fixed. BBB has the comparative advantage in floating. It will almost always be that case because of what we call the term structure of credit spreads. Higher quality entities tend to have bigger advantages the further out you go, just because it's more likely BBB is going to default in 5 years than it is they're going to default in, say, 3 months. All right, so there's that question. The next one is the swap itself. So calculate the ultimate borrowing cost of AAA and BBB if these two entities, now we haven't done anything. In number one, we still haven't done anything with the swap. So here's the first time the swap shows up. Calculate the ultimate borrowing cost for AAA and for BBB if they borrow in the swap in the debt markets, where they have a comparative advantage, and then enter into a fixed for floating interest rate swap where AAA pays LIBOR to BBB and BBB plays Treasuries plus 150 to AAA. All right, let all that sink in. Put this on pause and just look at it. And now I'm going to show you a swap. I don't know if you've ever done a swap before at UTSA, but if this is the first time, it might be a little confusing the first time you see it, but trust me, you'll get this quickly. All right, so let's work this problem. I did have a schematic, but I've looked at the schematic a student built, and they've got some of the numbers backwards, so I won't use that. So AAA is going to borrow where they have the comparative advantage. So they borrow, let's say, it's not in the problem, let's say 500 million at fixed. So they're going to pay Treasuries plus, if you just look up here, Treasuries plus 125. BBB is going to borrow, again, let's say 500 million. So, they just need, 500 million is not important. It could be $600 million. At floating, you're going to pay LIBOR plus 20. All right? So nothing usual about here other than they're going to borrow where they have the comparative advantage. So we haven't done anything strange here. They're just borrowing money. No big deal. And then we have the swap. And the swap, AAA is going to pay LIBOR and receive T plus 140. Here the swap, they are going to pay T plus 140 and receive L. So let's do this. What is their ultimate cost? So look at how I do this. If they're paying something either to the debt markets or to BBB, we'll do that as a plus sign. So they're going to pay T, they're going to pay 125. They are going to pay LIBOR, and they are going to receive T. This is really important. They're receiving T and they're receiving 140. All right, make sure you do both of those. So the cost is going to be what? Well, the T's cancel out. So all we're left with is the L. And we have 125 minus 140, that's L minus 15. That's their cost of debt versus what would they have borrowed in the markets. The markets, they would have borrowed LIBOR plus 10. So they save what? 25 basis points, cheaper debt. Now you say, well, my word, how did they do that? It must mean that Triple B is paying much more for their debt, right? If Triple A is coming out ahead, obviously Triple B is coming out behind. Well, let's look at their ultimate costs. So they're going to pay plus LIBOR plus 20, and then they're going to receive LIBOR, and they're going to pay Treasuries plus 140. So their cost here, the L's cancel out. So all we have is plus T plus 160. How much worse are they than we expected? Well, they would have borrowed at T plus 185. So they save the same 25 basis points, cheaper debt. How in the world do we do this? Magic. I think it's magic. I love it. That's why I love swaps. They're such a wonderful thing. But how did they both come out ahead? And what we're doing here, and this is a key, the reason I told you the term structure of credit spreads, that's the real key here. Look back up here. 60 basis points cheaper for AAA on fixed, 10 cheaper for Triple B. What's 60 minus 10? It's 50. That means the term structure of credit spreads gaps out 50 basis points. As you go out on the curve, AAA picks up an extra 50 basis points cheaper debt. What we're going to do, take that 50, we're going to take that 50 and essentially divide it equally between AAA and Triple B. Take advantage of AAA's comparative advantage out there on the long end, and we'll essentially take that advantage and split it between AAA and Triple B so they both come out ahead 25 basis points. Now 25 is a lot. It's unlikely a firm would see that much in savings, but I know at USAA, a good friend of mine was doing the debt for USAA, and he figured out a way using swaps and some Euro debt desk to save about 13 basis points. So you can do the math. 13 basis points times $3 billion. You can try that math. It's not a small number at all. I'll do it real quick. It's about almost $4 million a year. So it's not a small number. So you know, his income, his salary from USA was up $4 million, and yet in that one transaction he could save the company $4 million. That's another reason I love finance. We have so much power in our hands that really add a lot of value or destroy companies. We could do either one, but he had ability there to actually save the company money. All right, we'll do another example of this next class. So I just want this class to get you going. The next question I ask is a very, very important one. This looks like magic. Some people actually call it interest rate swap arbitrage. Arbitrage is when you make money without any risk or not anything invested. So remember here at the swap, we didn't have to spend any money at all. The swap has zero cost. We just set it up, so there's zero cost. So we have something that didn't cost us anything, and we suddenly get this benefit of 25 basis points. So it looks like arbitrage. We get something without investing anything. But it's really not arbitrage because while you're reducing interest rate risk, you're picking up a whole new risk called credit risk. And the credit risk is a very specialized credit risk called counterparty risk. So on your paper one, I really strongly recommend that you do a search on the term counterparty risk, and you also look for the term master netting. firms. It's usually master netting arrangements, but there might be master netting contracts or whatever. Master netting arrangements are related to counterparty risk. Counterparty risk is, the risk, you got this whole transaction going with the swap. Paying LIBOR, receiving T plus 140. Sometimes this will be 2% and that's 4%. So I'm paying 2 and receiving 4, so I'm getting cash. So I'm really worried about the other entity going under. Sometimes I might be paying 4% and receiving 3, so I owe money to the other party, so I'm not as concerned about them going insolvent. And so that's what it's called counterparty risk. Usually when you loan someone money, you're always worried about them going insolvent, defaulting on the debt. With counterparty risk, sometimes you owe them, sometimes they owe you. So, and just because you owe them doesn't mean there's not any risk, because interest rates could change dramatically and tomorrow, and suddenly they owe you. So we'll talk about this more. We'll get into this more when we talk about credit risk. But it's a special type of risk. Here your counterparty, and I set this up a little incorrectly. I made it look like AAA and BBB are dealing with each other, but in reality, there is a counterparty in between the two of them. An investment bank like JP Morgan or Morgan Stanley or Goldman Sachs, there's a counterparty in between, and that is where your counterparty risk is. So AAA is not exposed to BBB. AAA is exposed to maybe Morgan Stanley, and Morgan Stanley is exposed to AAA and BBB. And so what Morgan Stanley will do is a master netting arrangement to make sure if they have 40 of these contracts with an entity, and some of the contracts they owe money, some of the contracts the entity owes them money, they're allowed to net them all together such that they only have one netted exposure. And we'll talk about that with counterparty risk a little bit more, why that's so important. It has to do with credit laws, bankruptcy laws. So we'll get into that a little bit more. And the last thing we have here is, well, not the last. The second last thing is, before we get into dollar duration gap analysis, is which side of the transaction should the bank in the previous question take? All right, so let's go back and reestablish all of this. Remember the last bank, the bank we saw had a duration of net worth of 6.4 years. 43 years. That's too long. It needs to be 5 or shorter. So the duration of their net worth is too high. So we need to reduce the duration of assets or increase the duration of liabilities. Remember, for banks, I said we're going to focus on the liability side. We want to increase the duration of the liabilities. So we want to take a position that increases the duration of our liabilities. So let's look at BBB. Well, let's start with AAA. AAA started fixed and ended up floating. What did they do with their liabilities? They reduced the duration of liabilities. What did BBB do? BBB started floating and ended up fixed. They increased the duration of liabilities. So which side of the transaction we want to be on? Well, remember, we wanted to be on the side of the transaction to increase the duration of liabilities. Our duration of net worth was too high, so our duration of assets needed to be reduced. Our duration of liabilities needed to be increased. We wanted to be on BBB's side of the transaction. We wanted to start off floating and do a swap where we receive floating, pay fixed, so we end up with fixed at the other side. So we want to be on BBB's side. On the exam, I want you to give me the full answer. BBB, because they started floating, ended up fixed, thus they increased the duration of liabilities and they reduced the duration of net worth. Let me show you the wrong answer. I've seen this before and I will count off for this. Thus, increasing liabilities and reducing net worth. That is absolutely wrong. No one wants to reduce net worth. I mean, unless you pay a dividend or buy stock back, you don't want your net worth to go down. So make sure, I'm real picky on this, not because I'm picky, but because I want to make sure you really understand. they're increasing the duration of their liabilities. They're not increasing their liabilities. And they're reducing the duration of their net worth. They're not reducing their net worth. All right? So on the exam, I am extremely, extremely picky that you say it very precisely. All right? The last question we'll do really, really quickly because of time. Here I give you a little schematic. If duration of net worth is too low, too negative, the exact opposite of what we just did, you need to increase duration of assets, decrease duration of liabilities. Because we're focused on the liability side, there we'd want to decrease the duration of liabilities, so we want to swap from fixed to floating. That's what AAA did. And will almost always be AAA because remember the term structure of credit spreads. If duration is too high, the problem we just did, we need to decrease duration of assets, increase duration of liabilities. For the swap, we're going to be increased duration of liabilities by swapping from floating to fixed. That's what BBB did in our example. So, yeah, those are the solutions. Now I'm doing this before the class starts, so it's possible my class notes might actually have some of the stuff that I've just typed now, and you're seeing me type it now. So I'm not sure exactly what set of notes I will save out there for you. All right, the very, very last thing we got to do is dollar duration gap analysis. Almost 100% of students get this right, so it's a fairly easy thing to do. So remember, our duration of assets was 4.42 years. Our assets was $1 billion. Our duration of liabilities are 3.75 years. So our duration of liabilities was 750. So our duration of net worth was 6.43 years. So the dollar duration gap analysis is duration of assets times the value of assets minus duration of liabilities times the value of liabilities. Real simple. So 4.42 times $1 billion minus 3.75 times 750. The dollar duration gap that we have is $1.6 million, $1 billion. I think this is billion. So what does that mean? Well, that tells us how much notional amount we need. So right here, let's assume the interest rate swap has a 5-year duration. Then what we want in a notional amount is our dollar duration gap, 1.6 billion divided by 5. We would want to buy a $300 million swap. All right, so the notional amount on this swap would not be $500 million. The notional amount on the swap that BBB would do would be $321.5 million. All right, we'll do this again next class. Don't worry, I'm going to do an entire example again to get more practice. This class, the goal was just to get through everything once so you could see it, and we'll do more practicing, including in our online live sessions. We'll do more practicing. All right, so there's our first problem. We will do another problem. The next time, I recommend you work the problem yourself. There's some internet, YouTubes out there that do it as well, so you can practice before you start the next class.